In the last 48 hours, there were several major headlines, one of which is that JP Morgan is acquiring the distressed First Republic Bank. New York Times had this infographic showing First Republic, Silicon Valley, Signature Bank, in total around $500 billion in assets for these different failed institutions, and that it's comparable to the dozens of institutions that failed during the Great Financial Crisis. Similarly, if you adjust for inflation, of around $500 billion. So this is what the New York Times is comparing the failed institutions in terms of asset size. Now, I previously did a video on First Republic warning investors. This is part 2. This was in March, warning investors that First Republic was likely insolvent. The short reason why is because their loan portfolio, which they acknowledged, this is in their financial report, they said their loan portfolio effectively was worth over $20 billion less than what they were carrying for on their balance sheet. And that was well in excess of the underlying equity in the bank. So the equity had negative value, and that's why it would be very tough for First Republic to recover. And so I previously did a video on that if you want to understand that in greater detail. Now, similarly, in the last 48 hours, you've also seen Charlie Munger, interviewed by the Financial Times, talk about how U.S. banks are full of bad commercial property loans, and he foresees pain to come. Now, he's one of the greatest investors of all time. He's a billionaire. Why does he say trouble for banks? What is the problem that we see here? So part of it is that interest rates have moved significantly higher. And this is the 1-year U.S. Treasury yield at the start of 2022. It was closer to 0%. I think it was 0.3, 0.4%. Now, in the last few months, it's been closer to 5%. That's a huge impact on 1-year U.S. Treasury yields. It's not only treasury yields, it's also cash. I personally keep my cash at Interactive Brokers. Now cash is yielding 4.3% plus at Interactive Brokers. Once again, see the link below. You look at other deposit bases with various different banks, they're paying closer to 0%. And that's a real challenge for them as folks say, hey, we can move our deposits, we can move our cash to higher yielding areas. But there's also a challenge in terms of their mortgage, in terms of the mortgages that they have on commercial property. And so let me walk through a very rough example here. So assume you have a property with $1 million in free cash flow. With cash yielding close to 0, you'd say, okay, my cash yield 0%. I need some sort of spread, some sort of, risk, that I'm taking here with this property. Maybe people don't rent it out in the future. Maybe there's an earthquake. Who knows, what are the associated risks, or I'm going to be investing for a long time period. So I want some sort of spread above the cash yield. So I want a 4% spread. So that gets to around a 4% rate. So that means on this $1 million in free cash flow, which this building is generating, you could say, okay, well, maybe the valuation here should be around $25 million. $1 million divided by 0.04 or 4% gets to $25 million. Then you go to your local banker and you say, okay, this building's worth $25 million. I've corroborated with a few different people. They all say $25 million based on this very rough math. Then the banker says, okay, well, I can do a loan. I can provide a mortgage, and we can do up to 80% loan to value. So that's $20 million. And you only have to put in $5 million to, buy this building that you think is worth $25 million. So that's good times when interest rates are low. The problem is we've gone from 0 interest rates now to much higher in real interest rates. As I've just mentioned, now cash is yielding well over 4%. And so if you are in an environment where the same building is generating $1 million in free cash flow, and we'll talk about why it might not be in just a second. So you have $1 million in free cash flow, then you have a cash yield of 4%. Okay, so you need a spread on top of that 4%. Well, the spread shouldn't go down much. If anything, if there's fears of maybe an economic recession or having trouble renting out your building, maybe the spread would even widen significantly. But let's just assume that it stays flat. So the same spread as during the good times, but now there's a real opportunity cost with cash. So now the rate for the same building is, let's say, 8%. So this valuation goes from $25 million to $12.5 million. It gets cut in half just because cash has gone from yielding 0 to 4%. And the rate, the spread on this, some people might describe this as a cap rate, has doubled from 4 to 8%. And so here in this situation, the valuation has fallen in half, yet you still have a $20 million mortgage. So that means the owner is significantly underwater to the tune of $7.5 million. So this is why you're starting to see some major headlines about major investors, Blackstone, Brookfield, major investors in corporate, real estate, saying commercial real estate, saying, yeah, we're just not going to pay. We're going to default on this mortgage because they're looking at very rough math like this and saying, yeah, we're just too far in the hole. It just doesn't make sense for us now. And there's two reasons why the cash flow has actually gotten worse. One of which is the work from home trend, where the vacancy rates are much higher than what they probably modeled out, let's say back in 2019 or 2018. Another key aspect is that interest rates are now much higher. So the refinancing costs on that mortgage is now much higher, so that free cash flow is much lower. Now you might have some sort of offsetting effects, some escalator clauses where you can raise your rent over time. So there are those different dynamics. That's why in this assumption I assumed free cash flow was flat, but even that might prove to be aggressive in this very hypothetical scenario. But this does show you why a lot of banks are going to be looking at this and saying, holy smokes, we now own this property because the equity investor is walking away. And by the way, the loan to value isn't a conservative 80%. It might be closer to 160, in which case we might be facing a haircut. Now, Charlie Munger did add, it's not nearly as bad as it was in 2008. And he's very much right there, because unlike 2008 during the great financial crisis, where you're looking at systemically important institutions on the brink, the AIGs of the world, Lehman Brothers failed, huge banks, imploding. Now you're looking at mid-sized banks that really, they were investing in duration. They were investing for 20-year, 15-year, portfolios, and they just were caught off, they were caught by surprise with how quickly interest rates moved higher. And I showed you how, the 1-year US Treasury has moved up significantly since the start of 2022. So we're not looking at the same problem that we had during the great financial crisis, but there are important secondary effects. And Charlie Munger once again calls out every bank in the country is way tighter on real estate loans today than they were 6 months ago. And this has significant repercussions for the economy, because as banks tighten credit, that means buyers go say, well, we don't have the same purchasing power to go buy XYZ property. And as credit gets pulled from the economy, that does create the risk of a hard landing. That does create the risk of significant pressure, not only on financial assets, but also just demand broadly in the economy. And this isn't, unlike what Charlie Munger was saying, it isn't just tied to commercial real estate. This is a resource from I believe the Wall Street Journal as well as the Federal Reserve. This is a super important graphic. I think this is something that you should sort of burn into your head when you thinking about, how things play out, is that credit oftentimes leads the economy. And you can see, credit standards, much stingier standards. Banks are tightening up on commercial real estate, middle market companies, so small companies, loans to small businesses, credit cards. It is much, much tougher to get a loan. And when this spikes up, you see demand start to crumble in the economy. This results in this increases the likelihood significantly of a hard landing, a tough recession type of scenario. You see when credit standards tighten. You saw that happen during 2020, as COVID was impacting. You saw that happen during the great financial crisis, first in 2007 with commercial real estate, then, everything else started surging higher. You also saw it during the recession that occurred after the dot-com implosion, 2001, 2002. You saw, it start spiking higher. So this is very important data point to consider, that as banks start pulling credit, it has a real impact on the economy and businesses in general. Okay, so what happens from here to understand, what are the possibilities? First of all, in full disclosure, this is not financial advice. And if you're looking to take charge of your investment journey, consider unrivaledinvesting.com for compelling investment ideas, real-time portfolio updates, and our exclusive Discord server available for annual subscribers. So a few key things to consider. The first of all is, as banks are effectively left holding the keys for a lot of different properties, they're going to be saying, we can't own distressed assets. That's, from a regulatory perspective, it's also, there's a challenge with capital constraints in terms of the regulators say, well, how much, distressed properties do you own, other real estate owned? And they go, yeah, you're not allowed to own XYZ percentage. And so that puts them in a position where they say, okay, we're a forced seller because we can't hold over a certain percent of distressed assets on our portfolio. And it's also outside their business. They're not looking to manage a portfolio of distressed assets. They want to have a cash flowing loan portfolio that they could borrow against. It's much harder to borrow against a distressed property. So you're going to see sales in the future. And so this is, first of all, really key important to consider, is that if you have cash in tough periods like this, you're going to be able to capitalize on that. So the folks that have cash that can say, hey, I can either negotiate with the bank and buy these properties, or they're just going to benefit from the broader ramifications of, tighter credit and being able to provide capital when, asset prices come under pressure. That is, the position to be in, is where you have capital to, provide when you have forced sellers. That's the position. That's the other side of the trade that you want to be on. Another key aspect that we just saw earlier today is as capital starts getting pulled, it will flow through to the economy eventually. And so just today, we started seeing that the number of layoffs, discharges have surged higher, going back to around 2020. So it's jumped higher than expected. And you're also starting to see job openings starting to slide lower. This is the third month in a row. So is this enough in terms of a job softening to get inflation under control? We'll see. We'll see what the Federal Reserve does. And that really is the next key question. And leadership plays such an important role here. Is Jerome Powell... He strongly reacted during COVID. He wanted to make sure, the economy was forced to shut down, and that could have been a much, much worse recession if he hadn't reacted. The question is, what does he do from here? He's read Paul Volcker's biography. He's Paul Volcker, who beat inflation in the early 80s, late 1970s. He was looking at it and he just said, keeping at it, doing what it takes to crush inflation. And so, it's a question of how strong is Jerome Powell's resolve to make sure. And so far, you're seeing different indicators, one of which is as banks struggle, he goes, okay, well, we'll set up this loan program, and it's not printing money, but we'll provide sort of emergency financing. Yet at the same time, they're still expected to raise rates later this week. Another 0.25% is what's expected. And so they're still tightening. And so it's a question of, when does he start reversing course because things get so tough? And at the same time, when does he make sure that inflation is squarely solved? And so far, I don't think we're quite there yet, at least by the metrics that the Federal Reserve is tracking. So I think those are the key aspects to consider, one of which is you're going to see forced sellers. Two, you're going to see tighter credit standards resulting in broader pressure not only for financial assets, but also for the economy as a whole. And then at some point, you're going to see the Federal Reserve reverse course because that's what I would expect. They would reverse course because they'd say, okay, inflation looks like it's under control. And by the way, the economy is having some real trouble. At least that's the expectation, but we'll see. It's the reason why leadership is so important is you could also have leadership, and I'm not saying this is going to happen, but it's not without precedent. You could also have leadership that says, okay, well, just because these banks fail and the economy's starting to go under, if inflation's still too high, we're going to keep tightening. And that's the type of scenario that can lead to an even deeper recession and more prolonged recession. So that's why understanding what monetary policies are occurring is important to sort of reflect on. And also, I think another key aspect, especially when you look at that hypothetical, bank property example, is that it's important to have real rates when you're looking at things. Looking at that 4% spread because cash was, at such a low yield previously, that resulted in a lot of trouble for these banks. And so you want to think absolute return hurdles. For my own personal investment portfolio, I've raised the hurdles where I'm saying, hey, I want to make sure I'm having several 100% upside when I'm buying new things because of this broader pressure that I'm looking at and this broader, tougher environment that I think a lot of investors are going to be, experiencing that they're not really used to. I think this is very different than what they probably would have seen over the last several decades. So if you enjoyed this video, please make a point of hitting that thumbs up, hit that subscribe button. Thanks so much for watching Unrivaled Investing.